Hey, welcome back, options traders. Well, how likely is it to hit an all time high? It's a good question. And this came up when I was speaking to another trader trying to show the benefits of longer term trades. And I know everybody thinks that they have a better chance of making money by getting in and getting out. It's just a widely held belief out there. Everybody thinks you got to get in and get out. But if you think about it, if you get in, it's most likely going to go against you at some time. Why? Because you probably didn't buy at the low. And so traders end up buying these options. They get out after it goes against them a certain percentage. Let's say it's down 20% or something. And they think that they're managing risk. And all they do is they end up just spending a lot of commissions and a lot of in and out. And as I always tell traders, if you're not timing it right the first time, why do you think you've got better odds of closing that position and getting in at a different time? See, the problem is that when you've got lots of zigs and zags going in the markets, you are most likely not going to buy at a low. So that's kind of where I was coming with this study, and I thought, let's take a look at how often it is for a stock or an index to hit an all-time high and see if we can get some interesting insights from that. So let's jump over to an Excel spreadsheet and answer the question, how likely is it to hit an all-time high? Okay, now we're into an Excel spreadsheet, and I've chosen the S&P 500, the SPY ETF. You're certainly free to replicate this with different stocks, in which I have done that, and tend to get about the same results. So I've got three different time frames. The first sheet down here is for daily, and we're going to look at weekly and then monthly. So these are all closing prices going from January of 2000 through December of 2022. Now, the downloaded prices go out to 4 decimals. You can see right here. So just to use it in dollars and cents, I just rounded it to 2. So that's what this column is doing. And then all we're going to do is to do day-by-day comparisons. So for example, let's say this closing price right here was 139.75. Did that beat the closing price here of 145.44? No, it did not. So we get a 0. What about the next day, 140 even? Did that beat 145? No, it didn't. So what we're doing is for each row, we're looking at all of the closing prices before that. So 140 is not the highest in that list. So we still get a 0. Come down here, and then finally we hit 145.75. Now, is that the biggest number in that list right there? Yes, it is. So we record a 1. That's our first new high. Then we can see we beat it again, 146.25. So now we go to 2. And we just continue this methodology all the way down. So if you look, there's a lot of rows in here. We got 5788 rows. We had 352 all-time highs or new highs. So we're just going to take 352. Now, I'm not going to divide by 5788 because we actually have this header row, and then this was kind of our starting seed right here. So this was really our first point that we checked. So I'm just dividing that by 5786. And we got about 6.1% of the time. Now, here's the graph of these closing prices right here. But I want you to think about something for a moment. Now, these numbers are really compressed because there's just tons, and you saw how many rows are in there. So even though it might look like it's a fairly quick turn from here to here, it's not. There's a lot of downdrafts in there. And so think about it. If you're going to trade from here to here in that window, or here to here, or here to here, there's a very good chance you're going to get caught in a downdraft. But if we spread them out, because there's a long-term upward bias to the market, think about it. If we have, let's say if we put a dot here, and one here, and one here, and here, and here, how likely are you to find a high among those? Far more likely. Why? Because there's an upward bias. So that's kind of the logic behind it. We should see a higher percentage if we go over to weekly data. So what do you think is going to happen if we go from daily closings to weekly? Now, if we go to weekly data, Monday's opening price is the open, Friday's close is the close, the high and the low throughout the week are whichever days they occurred on. But again, we're just looking at the closing prices. So let's jump over to weekly and look at this. 11.6, almost doubled. We got 6.1, we've hit almost 12% just by going to weekly data. And we're starting to see the curve is starting to straighten out a little bit. We're getting rid of the noise, going far more into that fundamental trend, what engineers might call the signal. Get rid of the noise, all the zigs and zags. We're starting to see it kind of straighten out. Now, what do you suppose would happen if we jump over to monthly data? Well, let's try it. And look at that, almost doubled again, almost 21%. And we're seeing that the line is starting to straighten out. We're having a much better chance of catching a high. And so that's really what I wanted to show. It's a very simple way to intuitively understand why you have an advantage if you give yourself time. Now, in previous videos, we've also talked about the square root pricing rule, which means that per unit of time, your options are getting cheaper if you're buying a 6-month option or a 9-month option. Now, new traders usually see that they get more expensive in total, but divide them out by the number of days that you're controlling, and you'll see that that number is getting smaller and smaller. So you're getting cheaper units of time, and you're getting a better chance of seeing one of those all-time highs. So if you're not getting the results that you want from your options trading and you're going to shorter and shorter time frames, you're going in the wrong direction. Give yourself more time and you will see an improvement. Now, if for some reason the costs are an issue, well, this is where you can turn to strategies like a vertical spread or a diagonal spread to offset those costs. But the main thing is, don't buy shorter dated options just because they're either A, the only things you can afford, or you're afraid of losing a lot of money, so you only want to buy these really cheap options. That's really giving yourself a very high chance for losses. So I thought that would help for some of the new traders out there. Hope you found it interesting, and if you want, I would encourage you go to finance.yahoo.com, download your own data, and do your own studies, and I think you're going to find the same types of outcomes. So give yourself more time, and you'll have a much better chance of catching an all-time high. And if you're interested in learning more about the art and science of options trading, please check out the Alpha Trader course, Strategy Lab, and a brand new candlesticks and technical analysis course. It's all at optionsatoz.com. Also, please join us on Options A to Z's Facebook trading group, and you can find a link in the description below.